This week on Wealth Track, two top investment pros defy the naysayers and present the positive case for the U.S. economy and markets. BlackRock's chief equity strategist and respected fund manager Bob Dahl and Morgan Stanley's chief investment strategist and asset allocation master David Darst take on the pessimists. Next on Consuelo Mack, Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Additional funding provided by Loomis Sales. Investors seeking exceptional opportunities globally. Research affiliates. An efficient index for an inefficient market. Wintergreen, your home for global value. And Rosalind P. Walter.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. The stock market is famously known to climb a wall of worry. But in recent weeks, a wall of worries has dragged the markets down to one of the longest losing streaks of the last 10 years. The list of woes grew again this week. Industrial production figures for May showed almost no growth for the second month in a row. Retail sales for the month weakened as consumers cut spending for the first time in 11 months. Confidence among home builders fell to the lowest level since last September. But housing starts surprised on the upside as home building jumped in the West as other parts of the country languished. Now, some economists are now lowering their estimates of GDP growth for the second quarter from 3% to 2%. That after the first quarter came in at an anemic 1.8%, following better than 3% growth in the final 3 months of last year. A major concern is the health of the American consumer, who accounts for about 70% of economic activity. Continuing high unemployment, falling home prices, and high oil prices have taken their toll. Now, oil is off its highs, but the outlook for jobs and housing remains weak. Meanwhile, the high-stakes political battle over raising the federal debt ceiling so the Treasury can borrow money and the government can pay its bills is coming down to the wire. The deadline for an agreement is August 2nd, with no compromise yet in sight. Overseas, the prospects of a default in Greece has added to concerns about Europe's financial stability, while powerhouse emerging markets such as China and Brazil are putting on the brakes to fight domestic inflation. How serious is the global slowdown we are experiencing? Well, it depends upon whom you talk to. We decided to consult two top investment strategists for their take. Both are familiar faces to Wealth Track viewers. Bob Dahl is BlackRock's chief equity strategist and a respected fund manager who runs 3 large cap mutual funds: BlackRock Large Cap Value, Growth, and Core. David Darst is Morgan Stanley's chief investment strategist, a celebrated master of asset allocation, and author of several excellent books on the subject. In an interview earlier this week, I asked them how nervous they are about the economy.
Well, I'd feel better if things were getting stronger rather than weaker. There's no question about that, Consuelo. But we know economies never go in a straight line. We had a slowdown last summer, and we all got a little jittery. But at the end of the day, that was ill-founded, and we came back to a reasonable rate of growth. I think the same thing will happen here. The debate is how much of the slowdown is related to temporary things like Japan and the supply line disruptions, China in its slowdown, some unusual weather in the US, and how much is related to things that are going to last longer, a slowdown in demand. That's the debate, and we don't know the answer to that question yet. But as sure as we're talking here, I think things will turn around in the second half and do a little bit better. We're not going to set any records. We haven't so far this cycle. And unfortunately, when you slow down from a slow number, it's a little too close to zero for comfort, so people get jittery.
David Darst?
The Federal Reserve, Consuelo, as you know, back on June the 9th, reported their Beige Book survey of the 12 Federal Reserve regions. 4 indicated they were slowing, mainly in the Northeast and the Mid-Atlantic. 1 is increasing, that's Dallas, and 7 of them indicated that they look like they're holding steady gains. So we are of the belief Automobile production will pick up in the second half pretty strongly. We expect the trade component of the United States GDP to kick in very strongly in the fourth quarter. By the way this thing works, most of your trade effect does happen in the fourth quarter. So Morgan Stanley's economists have shaved their full year estimate somewhat, but they think the second half will resume a reasonably robust growth of about 3.6% annualized for the third quarter, and for the fourth quarter, 4.3%.
Where's the growth coming from?
The fourth quarter
this is a consumer economy.
1.5 points of the 4.3 is this trade effect, the export contribution. For us to be really worried, we would want to see valuations stretched. They don't seem stretched right now.
In the stock markets.
In the stock market. The market's trading for about 14 times next year's earnings. Earnings are holding up pretty well. They actually, many of the analysts are raising their estimates. We would want to see too much investor euphoria.
Right, in the markets, right.
In individual investor mentality and
Right.
psychology. And finally, the Federal Reserve raising interest rates, we don't see that. We see right now that they're actually going to push it out into late 2012 for their first raise. And so interest rates are very, very stimulative. For that reason, we agree with Bob Dahl. We do not see this being much more than a slowdown. But people are worried, confidence, housing, jobs.
Employment.
Yes.
Right. So, I mean, this is, all of your points well taken, but this is a consumer-driven economy. Consumers are, still deleveraging. I mean, they're borrowing a little bit more, right? So I mean, what do you do about the fact that 70% of the economy is still not robust?
Well,
manufacturing is, corporations are, but the consumer is not.
The consumer is not robust, but the consumer is participating in the economic recovery. And as David has articulated, neither of us are looking for strong growth because, in part, the consumer is retrenching and paying down some debt. But, we got all hung up on the most recent monthly jobs report. I think a lot of people have forgotten the 3 prior to it, which were as strong as we've seen in months and months and months. And so when you look at a 3-month moving average, I still think we're doing better. We're not going to set any records, but we're improving. And I think there's just so much skittishness out there. Every bad number gets accentuated in the marketplace, and the good ones are kind of forgotten about. And that's usually a good time to invest.
Yeah.
There's a swing factor to it. But corporations are basically sitting on tons and tons of cash. You've talked about it many weeks on your show.
Right.
$1.4 trillion on their balance sheet, about 7% of their total assets. It's one of the near the all-time record. They need to put this to work. We've seen the Fed play the monetary card. We've seen the administration and the Congress play the fiscal card, and still we haven't got that jobs. We think the card that must be played is the structural reform card. And the worse things get, the more people are going to concentrate on the fact that no president has ever been reelected when unemployment is above 7.4%. And it's right now 9.1%, Consuelo. The next job report is July the 8th, not July 1st. The first Friday in July, because of technical reasons, it will be reported the 8th of July. So you want to see those numbers, as Bob Dahl just said, 150,000 or more. That's a very important number for your viewers to look for as the July 8th number.
There was an article recently and a terrific interview with you in it was the weekend interview in the Wall Street Journal. And they portrayed you as a constructive bull. But I think one of the things that you said is that it's a lot worse in other places than it is in the U.S. So you're not a raging bull on the economy, but you are constructive.
Yeah, I think the line was best house in a difficult neighborhood.
Right.
Look, I don't want to back into the U.S. by damning everybody else, but it is true Europe's got lots of problems. The banking system is weaker there than it is here. Japan is in structural decline, not to mention the issues related to the earthquakes and the nuclear problems. And so it's the emerging markets that are going to carry the day, and I think the U.S. will provide and assist along the way. We have immigration and we have higher fertility rates, and those two things make our population and workforce growth so much stronger than Europe's and Japan, and that makes me long-term reasonably constructive on the U.S. And then to add to it, as David has already correctly pointed out, valuations are undemanding and are actually stocks, I would argue, cheap relative to inflation, returns on cash, and returns on treasuries.
So the markets then, and so Bob, how would you characterize yourself as far as your outlook for the stock markets?
I think, look, we've just exited in the U.S. recovery and entered expansion. We're in the early stages of this economic cycle. To think that the equity market would stop here and that we've seen the high already would be so unusual. So I remain constructive. I think we're in a cyclical bull market that's being interrupted with this sidewise pattern while we consolidate as a result of the slowdown. But I think we'll come on again. We've not seen the high. So I would be overweight in equities.
David Darst.
Consuelo, we're fundamentally constructive because the corporation's profitability, their balance sheets are in phenomenal shape. Credit markets, I think this is an oft overlooked fact right now. Companies are able to borrow in very good terms, large amounts at low interest rates. Secondly is this global growth that many U.S. companies, they're no longer strictly domestically oriented. They are participating very, very strongly. Anywhere from 30 up to 70% of the revenues of many of the big corporate giants of the United States are tied irrevocably to the growth story that's going on outside the United States, which is roughly 3 times what the U.S. growth rate is. So it's profits, it's growth, and finally is liquidity. Individuals, your viewers, and many of the Morgan Stanley and BlackRock customers fought this the whole way. They really never started buying stocks till December of 2009. The tax package was passed on December 18th. There was a change in control of the House on November 4th of 2010, and they really did not participate in this rally until recently. So there's still a lot of cash on the sidelines from individual investors that we think when things improve a little bit can fuel a further rally.
Corporations in America generated $500 billion of surplus free cash flow last year. Nobody predicted that. And so I think that's the fuel for above average increases in dividends, share buybacks, mergers and acquisitions, and most importantly, good old fashioned business reinvestment. Hire a worker or two, modernize a plant somewhere. This is good stuff.
So, and you know, David, you are the master of asset allocation. So when you look at the broad base of all the assets that we could invest in, and where do stocks,
Consuelo,
and specifically where do U.S. stocks come out?
We right
in your
now
estimation?
are underweight in cash. Cash gives you a very low yield, and very importantly, cash gives you a negative yield after inflation right now. So we are underweight versus a normal weighting in cash. With the bond yields having come down now,
right.
We think it's time to be a little bit underweight in bonds, and so we're
a
overweight.
Little bit.
Well, we have a 34%, and we are now 27%. Let's say for a moderate high net worth investor, so 7% underweight versus a normal weighting. That's a blend of corporate and government bonds, as well as high yield and emerging market bonds. Our big overweights, Consuelo, are in equities, in commodities, in real estate investment trusts. We have a slight overweight in inflation-linked securities. So it's equities, meaning both U.S. equities, emerging market equities. They've underperformed this year. One of the most positive and constructive things in our view is many of these regimes in China, India, Russia, Brazil, they've raised interest rates to fight inflationary pressures. And the early look here, as we're in the middle of 2011, looks like that maybe these anti-inflation monetary policies are beginning to bite, which will let them ease off on the brake and let that natural growth continue to emerge. And so therefore, we're overweight emerging markets, we're overweight U.S. stocks, particularly high quality, large cap, Bob Dole type stocks.
Right. So David, let's talk strategy with you. And you mentioned some of the asset allocation decisions that you're making. So, but as far as strategy within the equity space, which is an asset that you two are favoring,
we like technology.
We
like technology. Those are some of these big global companies that are U.S. Giants that participate in this global growth. We like
Oracle and
Apple, for example, Apple
right.
has $100 billion in sales.
Intel.
$11 billion of Apple's sales are in China. They can't get enough of Apple products
iPads
in
and the
China. The iPad, the iPhone, there will be a cheaper version of the iPhone. The iPad is about to go corporate. The Bob Dolls of this world are going to say, all of you folks at BlackRock can now have iPads that make it so much easier to communicate with yourselves and with customers. We're going to have, we believe, the smart television, which will be a 2012 product.
From Apple.
From Apple, which allow you to watch TV over the internet and vice versa. So that will be another big boost, we think. We think that stock, which is about $330 a share, can earn $25 and that it can go to $425. That's Morgan Stanley's research people's price target for Apple right now. And we hope Mr. Job's health maintains itself and improves.
So technology,
healthcare. These companies sell for 12, 13, 14 times earnings. They give dividend yields of 3, 4, 5%. 5% in the UK, 3 to 4 in the United States.
and compare that to the 3% yield in the 10-year Treasury, and right.
And you know, it has a chance to grow. They were under a lot of pressure because of the healthcare legislation. You've got patent expiration. You've got certain companies, but they're buying biotech companies. They're buying other companies, the big ones, and they're squeezing out cost savings. So we think the earnings can surprise to the upside. And a third one that we like is a defensive sector, which is utilities. And again, this plays to this yield. This plays to this yield. The baby boomers, as they retire, the 77 million of us born between 1946 and 1964. Management of Morgan Stanley is always asking me, why are people buying so many bonds? Well, the two traumas of the stock market. They want yield, and they're getting closer to retirement.
Sure, they need the
and
income.
those three motivations, we think, will drive people to companies that can pay you nice, generous dividends. And that would be the healthcare and the utility sector. So we're positive on those two.
Bob,
I'm going to agree with two of the three sectors David just put on the table. So in cyclical land, we want to own technology. The U.S. is the world's leader, and we're gaining market share. These companies have the best ability to generate free cash flow and doing a phenomenal job of it. They learned their lessons in the year 2000 when we had the tech bust, and so they fared so much better in the problems we've had in this last recession. Energy, we're adding to on the weakness in cyclicals in this environment, thinking that's a good global cyclical to own as well. Our favorite defensive sector, healthcare.
which has done extremely well this year.
It has done well. We think it will continue for the same reasons David had. I would add to it, to healthcare, some of the healthcare service names, some of the HMOs and the like. We think their business model is still strong, and the public companies will continue to consolidate the industry.
And David Darst, you favor something that you call the global gorillas.
Global gorillas are these great giant corporations, Consuelo. They're U.S., they're U.K., they're Swiss, they are European, they are Canadian, and they have the penetration into these emerging markets. Many of the great consumer products companies that we all know, they're 30%. Some of the big beverage companies are 80% emerging markets.
Right, so you're talking about like Coca-Cola and Pepsi. And
that's correct. These companies, these
Procter
kinds
& Gamble,
of companies,
Nestle.
30% emerging markets exposure, and they are penetrating in and growing. And so these global gorillas are companies that have great balance sheets, very strong fortress-like positions within their domestic home markets, and now they're basically going out into the world and participating in this global growth. That's what we mean by global gorillas, and we like that as a theme.
Bob, so has the large cap ship finally come in after years of being denigrated and undervalued?
Increasingly so, Consuelo. Look, even now, we are down cap relative to our benchmark. We still find a lot of mid-cap names that are very interesting, that have good rates of growth. As the economy matures in its growth rate, that's the time when these big cap names really come on. So with each passing day, we're trimming a mid cap name and adding a mega cap name. So we're heading in that direction. I don't think you have to have all your money there, but that's where we're going, because along with the list that David just put on there for their attributes, I would add, and they are cheap.
And so give us some of the specifics that you think are holdings in the large cap space that
David mentioned
we should
Apple.
consider.
I would add Microsoft. Risk reward we think is interesting. If you like high free cash flow companies, a Dell Computer fits that bill. In energy space, a Chevron, a Conoco, I think fits the bill. I mentioned healthcare, Pfizer, done more restructuring than most of the others, United Healthcare in the healthcare service name. So there'd be a half dozen large cap names that should win.
So what's the one investment for a long-term diversified portfolio that all of us should own something of right now that looks like it's a bargain or undervalued? Bob Dahl?
I'd start where I finish where I started, U.S. companies. The U.S. stock market for all the
cap companies?
I think
we're going to have to drill down in that a little bit.
The drill down for me would be positive free cash flow. We are in an environment of slow growth. We're in an environment of herky-jerky growth, as we talked about earlier in the show. And so I want companies that have financial flexibility, extra degrees of freedom. And one way to measure that, I think, is free cash flow. So if we can find companies with double-digit free cash flow yields, of which there are many, Dell Computer I mentioned, United Healthcare I mentioned, Sprint is another one that we think these companies have good risk-reward profiles.
Is there any, and I've asked you this over the years so many times, is there any such thing as a core holding anymore as far as a stock is concerned? Is there anything that you can buy and just hold on to and let that free cash flow pay you dividends and you reinvest or whatever?
If we were in a secular bull market, as we discussed earlier, I think we'd have a long list. But given that we're in this flip-flopping around cyclical bull market, interruptions along the way, I think everything has a buy price and everything has a sell price.
Beautifully said. Consuelo, as far as a single area, I would want your investors and viewers to know about the oil services complex. You have some companies that are very domestic U.S. oriented that have lagged. Classic case is Halliburton. Now we get we get all this onshore drilling activity these days for gas, the gas shale, and also oil shale, believe it or not. So there's been a big upsurge in rig activity and drilling activity. You want to put that together and make a package with the two big offshore international, not just meaning offshore in the ocean, but outside the United States, and that would be Schlumberger and Baker. Schlumberger is about an $80 billion market cap company. Baker's about a $30 billion, and Halliburton's about a $50. So you put those three together, and Schlumberger they basically took over Smith International, and they are integrating that, squeezing out costs, and now they can go to the government of Saudi Arabia, Kazakhstan, Angola, Venezuela, and say, you've got that oil and gas there, but you can't touch it without our full soup to nuts package, which they did not have before. So they can go A to Z, and they've got a 40% market share, number one or number two in many of these things. So we say, don't try to rifle shot and just pick one, but take a package of Schlumberger, Baker, and Halliburton.
Final question to each of you, and that is are there any outliers in the market? Is there something that basically that the consensus is missing? It's either a risk or an opportunity? Bob?
I think investors or the investment community is missing the attractiveness of common stocks. Back to what we've been talking about. When you can get a yield on S&P 500 that is as high as it is compared to other alternatives you have, treasuries we've talked about several points in time. Even when you look at the earnings yield, the inverse of PEs, and compare that to high yield bonds, we're at record levels. So I think the attractiveness of stocks relative to other common investments, cash and treasuries, is being missed by the marketplace.
So what's the consensus missing, David Darst?
Consuelo, I think the President of the United States, our 44th President, is very well aware of this number of 7.4%, and I believe something's got
unemployment rate.
Unemployment rate. But if it's above that, it's very hard to get reelected. Everybody knows this, and I would be very surprised if we didn't see some shift one way or another by people looking for reelection, not just in the White House, but in Congress, Senate, and House, that they've got to get some policies on the table, and I believe that those will be investor friendly and they will be economic and U.S. economy friendly, those policies. This is not wishing and hoping, but I believe that We've done the monetary, we've done the fiscal. Now it's time for something structural, and I think that could be a very nice, positive surprise to your viewers.
Where do we
sure
sign?
Hope, excuse me?
Where do we sign?
Exactly
That would be
what I
great.
was going to say. I sure hope they're listening to you, David Darst. And we are all listening to you,
Thank you.
David
Thank
Darst from Morgan Stanley,
Thank
and
you.
to you, Bob Dahl from BlackRock. Thanks so much for being
Thank you,
on
Consuelo.
WealthTrack.
Thank you for having us.
This week, we want to offer you some summer reading suggestions from a few of our regular guests. Wintergreen Fund's David Winters recommends The Rational Optimist by science journalist Matt Ridley. It's a survey of human ingenuity over the centuries, and Winters says it contains many reasons to be optimistic about the future. Loomis Sales bond manager Dan Fuss's choice is Capitalism 4.0 by Anatol Koletsky. It's about the resilience of democratic capitalism. Fuss says it will broaden the views of investors, even though you don't agree with his major points. And that concludes this edition of WealthTrack. I hope you can join us next week for a potentially investment-changing discussion with financial thought leader Michael Mauboussin. The chief investment strategist of Legg Mason Capital Management will explain why doing less in the markets can actually make you more. Thank you for taking the time to visit with us. Make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales. Investors seeking exceptional opportunities globally. Research affiliates. An efficient index for an inefficient market. Wintergreen, your home for global value. And Rosalind P. Walter.